Hey folks, welcome to today's stream. It's going to be a fast one today. We're really just going to talk about a few of the benchmarks that we're approaching and actually what might happen if those benchmarks fail, right? So, institutional benchmarks, my friends, I don't know. There's probably more than one person watching this, so let's say friends. Right? Institutional benchmarks are tools used by institutions to measure performance, right? Do you remember when we were on the daily, how important it was when we crossed below the daily 200 moving average? Right. So let's go back to the previous crash pattern and take a look at this, right? So it was a pretty common thought that as long as we were staying above that daily 200 moving average, we would at least stay bullish, okay? So let's pull this in a little bit closer. And do excuse the long load times. 3D Wave PM is a bit of a monster as far as actually chart load times go, right? We did have an overexpanded period on the 200 band, so price reverted to the 200 MA as defined by that overexpanded period, right? So we reverted to that MA. We saw high price volatility exactly on the MA, right? Because it is a benchmark that defines performance. So if we're directly on top of something that defines performance and we aren't weighted to the upside or the downside, that's going to be a very neutral and indecisive chart. And do give me 1 second. I actually would like to record this as a TradingView idea, so I will repeat myself here just for a second. Hey folks, I really want to point out the importance of the institutional benchmark of the 250 moving averages on the daily chart and above, right? If you have a tool that's designed to measure performance for institutional investors, or at least that's its most frequent application, you're going to find a lot of buying and selling pressure to actually get that direction defined, right? Imagine you have a seesaw, right? The left side is bullish, the right side is bearish. Well, if you have two people sitting on the seesaw trying to push a bowling ball, either to the right side or the left side of the seesaw, whichever person wins is going to get a more defined direction, right? And as soon as that person wins, the person who lost is going to have to cover their positions by closing out any shorts they had as soon as you get the upward rebound. And any person who was having significant selling pressure, well, let's say if we broke down, whoever had longs open, they're going to have to start closing their longs as well, right? So if you ever trade laterally directly on top of a benchmark, you will get high price volatility due to conflicting order flow. Yeah, we can actually see this on charts, say GBP USD on the monthly, for example. And actually, I would like to use a different ticker for that so we get a longer history. Okay, if we pop over to the monthly, every time we approach the 1.25 standard deviation of our institutional benchmarks of the 50 or 200 MAs, we see significantly high price volatility, right? Because there is trillions of dollars of conflicting order flow in each direction. Think about this. Do you see how every time that we touch an edge of the 200 band, the candles go up and down very rapidly. We get a lot of dojis, like so. Here, 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 and here, and here, right? Every time we attempt to cross a pivot for the long-term expansion or compression of a distribution, then there's going to be a lot of conflicting order flow as whichever side actually does end up trending, well, then the other person needs to close their positions in that direction, right? Think about this. Every time we get these kinds of dojis, right, on the benchmarks, this high price volatility, you'll notice that whenever direction is finally committed to, you're going to see one huge candle and then significant trend afterwards. Why? Well, because the person who is shorting here, right, the person who is selling here, all their selling pressure, well, they need to close those positions. They need to cover, they need to swap their positions into longs because expectations are once again aligned for growth, right? So every time this happens, we get significant candles and significant trend in that direction due to the battle, literally trillions of dollars of conflicting order flow in each direction, right? Now, this is going to be the same for moving averages as well, right? Because if you're above a moving average, it defines positive growth. If you're below, it defines negative growth, right? So, again, high price volatility directly on the key pivots. And as soon as we finally commit to a direction, you're going to get significant pressure. Beautiful. Little known secret, the 1.25 standard deviation of the 250 bands on the monthly and weekly are institutional benchmarks. They do define performance, and you very much should have them available to define high price volatility at key pivots, right? Let's say you're trading here and you're getting a bunch of choppy trading action and you don't know why. Well, it's because you haven't looked on a high enough time frame, right? Always start on the macro, work your way down. That's your best bet. All right, let's actually take this back to Bitcoin. Beautiful. Beautiful, beautiful, beautiful. Guess what happens? If we re-enter the 50 band, it is implied we will return to the 50 moving average. Okay? Mean reversions topple their way down. And I could load up the BLX chart with this for the weekly. However, I think my point is just about made here. Now, I do think that we are going to bounce directly on top of this MA. We might get some high price volatility. If we do go directly on top of it, you'll notice that if we actually look at the previous crash pattern, there are significant wicks directly on this because of how heavily defended that pivot for growth or decay is. So we actually need to talk about what happens if that pivot is broken and we do get sustained trend to the downside, right? Well, here's a fun fact. We are still technically in a state of decay. We are still in downward expansion as defined by the longest overexpanded period on the daily chart. We are still in a downtrend, okay? And this is really nice to visualize with the 3D Wave PM as well. Take a look at this, my friends. Do you see how conflicting these signals here on the 3D Wave PM are? We have this huge, massive volatility overhead, right? However, all of the period subsets below the 100 period are completely compressed, right? We rarely see purple on this, but because Bitcoin has done nothing but trade sideways, we just compress, compress, compress. So this is where the important thing is. If you have very tight compression, it equates to the same as high potential energy. If you have a high potential energy, as soon as that ball, right, starts rolling one direction or another on the seesaw, it's very much going to commit to that direction. And this actually brings us to a problem, right? If we're expecting a retracement down to the weekly 200 moving average, any kind of downward expansion, well, there's going to be a lot of potential energy for that move. So we're actually going to get some pretty strong conflicting signals as we get net downward expansion in addition to defined downward trend as the longest overexpanded period. And then it's just going to be a question of, will the institutional benchmark of the weekly 200 moving average hold? So think about this. If we have two conflicting directions, what would be the best way to actually manage this position? Well, let's go over the options. One, you can layer buy orders down to the monthly 50 moving average, right? The lowest institutional benchmark we have available to us. Two, you're going to have a very tight stop loss on the 200 weekly moving average. However, I do not recommend this due to the nature of high price volatility at key pivots, right? If you're expecting high price volatility, you're going to have a bad time because you're more likely to get stopped out if there's a bunch of wicks. And finally, my personal favorite scenario is define the range that we will trade in, right? We are currently compressing, compressing, compressing. So we're actually not defined all that much by a range at the moment because the next time we start expanding, it will define trend rather significantly, okay? It is important to note, as soon as we re-enter the purple band, we will expect reversion to its relative 250 period mean. However, it is also equally likely that price action, or rather, I'm sorry, instead of price action traveling up to meet the mean, it is more likely that the 250 moving average will travel down to meet price, right? Really, I think the most significant scenario, and honestly the most beneficial scenario, would be continuous lateral trading, which would allow the dissipation of this volatility overhead, net compression across all periods, so that finally, when this starts tipping one direction or another, it will take very low force in order to move something with very low mass, okay? And that is what's beautiful about this chart. We will get very defined trend as soon as it starts expanding one direction or another, right? Look at this area where we have virtually no volatility overhead. Everything's in the blue or green, right? Significantly compressed. So as soon as we started seeing this expansion, all the CCI periods weighted themselves to the same side, and every single wave PM period started expanding in the same direction, that defined a very significant trend, right? The last time we saw that was during the bull run. Now we're getting our nice period of compression because the end of a crash pattern is defined by a period of reduced volume and reduced price volatility. And that's exactly what we're seeing now. So if we do see downward expansion, we will very much be able to define that trend and trade it successfully. However, if we do get downward expansion, I will be stopping out of my longs. I would have been wrong, and that's absolutely fine, because it's not about how often you're right or wrong. It's about how much you make when you're right and how much you lose when you're wrong. Dad Shark out. Beautiful. Oh, that was fun. I wonder how many people are viewing. I know I'm streaming really late, so I'm not getting anybody from Europe. If you are from Europe, give me a shout out. I'll say hi to you. It could be fun. I'm going to pull up YouTube here so I can see you guys' comments. Ooh, I just said guys's. Jesus. That offends my sensibilities. I got Jason Smith asking me to look at XEM, and yes, I will. Then I'll probably get on the live stream because nobody's really watching right now, and I really just wanted to keep consistent with keeping a TradingView idea released every single day, right? I was obliged to go to a family Super Bowl party. I did leave early. Well, because honestly, I wanted to get home and get to work, and I owe somebody a spreadsheet. So, time to get to work. Can I look at Zem? Yeah, I can. SEM, BTC. Yeah, Jason Smith, thank you for watching. It is my pleasure to be here. Oh, man. Why do you even want to look at a chart like this, bro? You know, let's define this in its simplest terms. Okay, your 50 band is overexpanded. As long as your 50 band continues to expand, it will continue adding mass. The more mass it has, the harder it will be to move. And as soon as you return inside the 50 band, we will either revert to the 50 mean through a trending move, or we will revert to the 50 mean through a lateral move as this mean falls down to meet price. You know what this is called? A bear flag. That is what a bear flag is, my friends. The compression of short-term periods to allow for the reduction of mass so that there can once again be a higher potential energy for when the new expansion defines trend, right? And you can see this on charts like ONT really nicely. You're going to like this. I think ONT is one of like the best examples to define bear flags in my opinion, just from historically how well it's gone. And yes, I'm cherry picking. I like to cherry pick, but only when the cherries are this fresh. Okay? Just looking at this 50 band is gorgeous. And let's go ahead and hide the 200 just for the sake of sanity. Beautiful. Okay. And actually, let's only have the 50 period wave PM open just to make this super attractive. And this is information I do give out in my lessons. So I'm feeling generous today. And no one's watching, so, joke's on you. Okay, watch this, friends. You're going to like this. if the 50 period is overexpanded and we turn inside the 50 band, guess where price reverts to? The 50 moving average. 50 periods overexpanded. We return inside the 50 band. Price reverts to the 50 moving average. This one doesn't count. Why? Because it's not overexpanded and we don't revert to the 50 mean. But guess what is overexpanded? And I know this from looking at the chart. The 40 period is actually overexpanded and we revert to the 40 moving average before trend continuation, right? Because each time you see that these bands compress like so, well, that's just the reduction of mass to allow for higher potential energy to once again resume trend. Then, as soon as we get compression, we get lateral trading. Expansion, we get trend. Compression, we get lateral trading. Expansion, we get trend. And guess what happens when we get upward expansion? Whew. Well, it ends the downtrend because we no longer have a net weighting on our CCI periods. And we will now trade laterally as defined by the longest overexpanded period. In this case, that longest overexpanded period was 115, 120. So if I let up a 120 band, how much do you bet that price will be defined by the 120 band? You're not going to believe this. It's too accurate. And sometimes I get a little concerned because, for the love of God, who knows what I've stumbled upon. Ooh. $120. Now, high price volatility at the key pivot. Yeah, that's unfortunate. But from the looks of it, yes, we are defined, albeit briefly, by the 120 period. And then, as soon as we break below it, it defines a new brief downward trend. So, nothing's perfect. Although, honestly, this high price volatility does concern me. I want to find another example. I think it might be because of the longer overexpanded period from the previous trend actually did not define this newest plume, right? Because the lateral trading as defined by this newest plume is actually... No, this would be a scenario where we actually need to account for volatility overhead due to the severity of trend, right? So this huge plume here would actually be defining our longest overexpanded period. So we're actually going to need to go a higher daily time frame to prevent the early compression of those periods. I got bad news, though. Chart look back doesn't go that far. Okay. So let's actually just make an assumption in this case. From the looks of it, we are looking at from the highest overexpanded period in the first connected plume, 450 period. Okay, so if we change this to the 450 period, we should get more accurate results. Okay, this is acceptable. Oh, but it's not as pretty. But if we return inside this band, because it's overexpanded, we will trade laterally as defined by the band until its mass reading has sufficiently compressed. And then once again, as soon as you get new expansion defined by that period, well, it's going to define new trend. So compression, lateral trading, expansion, trend. Beautiful. Let me check the comments one last time, see how you guys are doing. XLM. Ha, funny. Didn't I just do XLM? No, I didn't. Okay, one sec. Hi, DeWood. How you doing? I'm going to refresh this template. Hold on. I'm going to do this chart and I'll be on my way. It's a beautiful day. I went hiking today and it was miserable. I had the bright idea to try to live stream from the top of the mountain, and who could have predicted I would have had bad service? Not I. Okay, is it the same story? We're still getting crazy downward expansion. You know, when you get these kinds of short-term inversions, but you're seeing that expansion from a place where you have completely new compression or completely net compression, when you're getting that kind of expansion all in the same direction, you really don't want to bet against trend. You know, I did briefly recommend a long when we tagged the 3.2 standard deviation on the daily chart, but I never officially released it due to the high risk of betting against the net expansion. Looks like right now we're just going to get some lateral trading as defined by the 50 period. You know, once that 50 period is... Ooh, it's close. Yeah, if one more candle closes and then trend can actually continue, unfortunately. Yeah, let's stay away from this at the moment. I guess we should quickly define our mean reversion pivot, which is going to be roughly around here as defined by the 250 band, okay? So we're not there yet. I did get a wave PM cross, I think, on the daily. No. You know, we are getting an interesting signal here, which is worth mentioning. And I actually want to test the signal on a few charts real quick because I'm just interested. Right, if 14 periods overexpanded, 14 period CCI rolls up, it implies reversion to the 14 mean. So let's just set this up to be just a 14 band real quick. Or for the sake of clarity, let's do 25. I mean, with overexpansion, you can choose it arbitrarily. It doesn't really matter. Why? Well, because you're going to have to respect the relative period anyway. When I say it doesn't really matter, I mean it's going to be accurate regardless of what period you look at, okay? Beautiful. And let's get away with the 3.2 standard deviation real quick. There's no real need. Okay. So, 25 periods overexpanded. Turn inside the 25 band, price versus the 25 mean. Woo! Let's find another example. Perfect. 25's overexpanded. Your return inside the 25 band, price versus the 25 mean. I'm going to do a Forex pair with this, just to have fun. Let's do... Forex is a little less accurate on this, but we'll do it anyway. GBP USD, because I have nothing to hide. Holy shit. This trade call is still active, guys. I'm really happy with this chart. And this is exactly why. 25 periods overexpanded. Prices return inside the 25 period band. Prices reverting to the 25 moving average. It is so clean. Where is GBP USD? I did make a chart for it. I don't really remember how long ago I did it. I'm gonna have to look for it later. Oh well. I don't think I actually named it anything too relevant. Oh, here we are. Yep. Right, tag the 3.2 standard deviation, and now we're actually seeing mean reversion for that period as well. Ready for this, guys? This is going to be a great trade. I wish I actually had this position open. It's a huge move. 2%. The right leverage, that could be like half your portfolio. Although I really don't recommend using that much, but you get the point. But anyway, my point was, with this kind of overexpansion, we get some really nice trends. Okay, here's another example. This one had a really bad time because of net expansion from 3D Wave PM, but you know, we return inside the band, price versus to the relative mean. Well, this one was pretty rough, let's be honest. Here's a good one. And I'm going to stop commentating them. I'm just going to start drawing them in. How big are these moves? These are huge. A nice one. Beautiful. And here's another one, actually. That's kind of nice. Two right there. From the looks of it, this succeeds more often than it fails. Because I'm not cherry picking these. I'm drawing every one I see. Just reversion after reversion after reversion. They keep on succeeding. It's ridiculous. Actually, it's kind of interesting to see how price volatility has increased for the British pound over the last 3 years. It used to be a much tighter range. Yeah, I remember watching some, I don't know, some of those clickbait mentorship YouTube videos a while back on Forex trading. You know, it's pretty useful information, like how exchanges take bets against you, all that jazz. But one of the things he said was, in the Forex markets now, there really just isn't enough volatility to actually make all that much money anymore because everything's automated. And it's interesting to see how price volatility has actually increased in recent times, albeit somewhat slightly. Albeit, oh my god. I just said albeit. Okay, well, this was fun. I'm going to post this TradingView idea. I'm probably going to stick around and chat for a bit. See how you guys are doing. I've got some work to do, actually, so I'll get around to it, guys. It's been fun. I'll talk to you later. See ya.